You check your balance. Once again, it's lower than you expected. A small charge one you haven't specifically agreed to waits at the bottom of the list. You sigh and close the app. It's unfair. It shouldn't happen to you. It didn't happen to your bank, though. It made money today. Off of you, a bank would rather have rich customers with money in their accounts. After all, the more money a bank has on deposit, the more they can lend out and profit from the interest. But take a closer look at the inner workings of a bank's finances, and the realization hits you. If anything, a bank would rather you be struggling. How could that possibly be true? Well, let's open up the textbook and start from the very bottom, shall we? A bank's primary function is to take deposits from people with extra money and lend it out to people who need it. By doing so, they make a small profit from the interest. Milton Friedman spent his life analyzing the effects of the interest rate and how its mere presence can affect an entirety of an economy. But these broad strokes of theory hide little details in the average customer's experience. That average customer at 3 in the morning trying to fill a tank of gas with the money in their checking account is the real face of a bank's business model. Let's take that business model and analyze the overdraft fee. An overdraft fee sounds a lot like a subscription, and in many ways it is. American banks make billions of dollars every year by taking these fees from their customers. But why is it that most of the people on the receiving end of these fees are the ones who don't get them very often? The Consumer Financial Protection Bureau has done some research, and it turns out that a small percentage of the bank's customers are responsible for most of the overdraft fees they collect. That's not a coincidence. An individual who has enough money in their account to avoid having to pay an overdraft fee in the first place is far less desirable to a bank than an individual who lives from paycheck to paycheck. The bank's ideal customer is someone who has a steady stream of disposable income, but not a whole lot of disposable money at any given point. They're the kind of people who are always one overdraft fee away from becoming significantly poorer. In fact, you can call them the people who are always one overdraft fee away from being significantly poorer, regardless of intent. If you want to understand the psychology behind this, you should probably talk to Richard Thaler. He has an interesting history of exploring the ways in which the average person behaves irrationally in their interactions with the economy. The most notable example is his work in behavioral economics, which described a series of ways in which humans systematically make errors in judgment. People tend to be far less sensitive to immediate costs than to immediate benefits, which causes them to always be one overdraft fee away from being significantly poorer. To use the example above, people who live paycheck to paycheck, especially those who don't save much of their earnings for later, tend to make decisions with a mindset of present self-interest. They want to spend money now to enjoy the benefits, but it's hard to enjoy the benefits when your present self has just spent all of your money. They also tend to greatly overestimate their ability to plan ahead, especially when the planning involves irregular expenses. It's all very frustrating, but a bank is always one overdraft fee away from getting significantly richer. There are some other ways in which banks can get significantly richer, though. The overdraft fee only makes up a part of the ways in which banks profit off of the poor. Take the minimum balance fee. For example, a bank account that used to have enough money in it until yesterday now has money taken out of it because it didn't meet the minimum balance requirement. Minimum balance fees are just another type of fee that banks use against the financially struggling. Similarly, credit card companies benefit significantly from customers who carry a balance from month to month, so they can charge them interest they knew the customer would never pay back now. Let's consider this situation. A credit card customer pays off their entire balance every month. Is the bank that owns the card happy to see them do so? Not really, not when you consider that the customer isn't making a minimum payment either. This is the type of scenario banks hope happens to their customers as often as possible. Because the customer is right in the sweet spot between being very profitable and completely unprofitable, this isn't a brand new issue either. In fact, it surfaced shortly after the 2008 crisis, when lawmakers tried to pass regulation to stop credit card companies from exploiting the loopholes in their favor. The Credit Card Act of 2009 was a direct response to the realization that the most profitable customers in regards to credit cards were the ones who were least likely to survive a financial crisis. Lawmakers acted upon the information the regulators had gathered, which in turn acted upon the information that had already become apparent to the public. Millions of people in the United States were living paycheck to paycheck, and unfortunately for them, payday lending was the cheapest way for them to get a loan. This in itself touches upon a fundamental truth about the modern economy: banks live and breathe risk. The more risk you take, the more reward you get if you survive that risk. A bank would rather lend to you than to the guy with a stable job, a mortgage, and a family to support, simply because you're a risk. Payday lenders know this risk well, which is why they're so eager to lend you an amount of money they know you can't repay in a very short amount of time, and with the help of the government. They get away with doing so. Is a bank inherently evil, because they exist for the sole reason of taking advantage of the disadvantaged? Probably not, unless you want to put their shareholders' interest in a position higher than everyone else's. A bank's job is to provide the bare minimum of what their customers need, while maximizing the amount of profit they can get away with earning. When their entire industry is built off of a business model that relies on people living paycheck to paycheck, it's only natural that banks start finding ways to help themselves. In this sense, banks are no different from any other business that exists solely to make more money than their competitors do. When they all chase after that goal, the entire financial system can, for brief moments, resemble a well-oiled machine with every piece working toward a singular goal. But the truth is, once any of these pieces realize they can take advantage of a particular group of individuals, they will do so. But how can this possibly change? Well, the first thing to happen is that your perception of a bank fee changes. It's not a personal failure. It's an opportunity presented to banks everywhere to make a small amount of money from you. Understanding this dynamic removes much of the shame involved with incurring a bank fee. And shame is one of the biggest reasons why people don't bring up the possibility of getting it removed in the first place. It turns out a lot of banks will be perfectly okay with reversing an overdraft fee simply because you, as a customer, ask them to do so now that you've seen the system for what it is. You can make better choices for yourself and make it harder for banks to profit off of you. Setting up automatic alerts in your bank account for when your balance is about to drop below a certain amount is a smart move. For the very reason that only a small percent of people actually use these alerts and benefit from them. Picking an account with no overdraft fees as opposed to an account with them is also a good move, especially as more and more banks start to realize that such fees are unnecessary for their finances. Finally, setting aside enough money to avoid those dreaded overdraft fees altogether is an even better move. Simply because it takes you out of the small percent of customers who are always one paycheck away from becoming significantly poorer. To summarize, let's put this all together. You check your balance. It's lower than expected yet again, and you see that small charge waiting at the bottom of the list. You sigh and close the app. It's unfair, and you know there's nothing you could have done to stop it. But that's not true, is it? It shouldn't have happened to begin with. It's a known fact that banks care more about keeping their shareholders happy than about caring for the average Joe. The same can be said about the bank's tendency to take advantage of the economically disadvantaged. But as the famous investor Benjamin Graham once wrote, the individual investor's worst enemy is likely to be himself. The worst enemy in our case is a bank fee. But it works in much the same way. When we're always one paycheck away from becoming significantly poorer, it's easy for us to forget that it doesn't have to be this way. It turns out it's not a matter of banks being inherently evil, but the system itself designed in such a way that the people who can afford to take risks are rewarded for doing so. But the same system has a weakness. It hinges on the very people who are prone to take those risks. And those people can, in time, learn to protect themselves from getting exploited by the banks in the first place.